Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into NetLink NBN Trust, one of Singapore's most stable, yet often misunderstood income plays. The latest analyst report gives it a neutral rating, with a target price of 87 cents. But does this rating really capture the full story? Are there hidden risks or opportunities that might be flying under the radar, especially for Singaporean investors thinking about CPF or SRS allocations? Stick around because I'll break down the numbers, challenge the consensus, and show you how this stock fits into the bigger picture of our evolving digital economy. Plus, for those who want to go even deeper, I'll share how you can access premium, members-only insights that could make all the difference in your portfolio. Let's start with the headline numbers. NetLink NBN Trust just reported its second half and full year results for financial year 2025. Revenue came in at $407 million, down about 1% from last year. Net profit slipped almost 8% to $95.4 million. The profit margin shrank from 25% to 23%. Distribution per unit, which is what you actually get as a unit holder, nudged up 1% to 5.36 cents for the year. That works out to a yield of about 5.9% at current prices. In other words, the business is steady, but not exactly firing on all cylinders. Now, why the neutral rating? The analysts point out that while operations are stable, NetLink is facing some headwinds. Non-residential connections are under pressure due to industry consolidation, which means some loss of customer share. At the same time, capital expenditure is ramping up. Think network upgrades and IT system overhauls. This is good for long-term resilience, but puts a strain on short-term cash flows. To keep up its generous payouts, NetLink has had to draw down an extra $91 million in borrowings this year. That's on top of an already hefty $810 million in total debt, with a major $510 million refinancing coming up in the middle of next year. If interest rates stay high, that could mean another $10 million in annual finance costs. Let's pause and ask, is this a red flag? Or just the price of doing business in a capital-intensive industry? Personally, I see both sides. On one hand, NetLink's business model is extremely defensive. It owns and operates the backbone of Singapore's fiber network, with a regulated asset base that guarantees a return on investment. About 62% of revenue comes from residential connections, which means every home that needs fast internet. These are sticky, recurring revenues, and the regulatory framework ensures that NetLink gets a fair, if not spectacular, return. Even with some pricing pressure, as residential connection charges drop from $13.80 to $13.50 this year, NetLink's cash flows remain robust. But here's where I challenge the consensus. The neutral rating makes sense if you're looking for explosive growth or big capital gains. NetLink isn't that kind of stock. Revenue growth is forecast at just 1.6% per year over the next 2 years, well below the Asian telecom sector average of 3.8%. Profit margins are under pressure from both rising costs and regulatory pricing reviews. And with more debt on the books, every uptick in interest rates bites a little harder. The recent results already show finance costs rising 19% year on year, even with most of the debt hedged at 2.75%. Once those hedges roll off, the pain could get worse. So why do investors, even big institutional ones, keep piling in? The answer is yield, stability, and predictability. NetLink's 5.9% yield is backed by strong recurring cash flows. The trust has a policy to distribute all available cash on a semi-annual basis, and the payout ratio is close to 100%. For CPF and SRS investors, this is a big deal. NetLink is an approved CPF investment scheme stock, which means you can use your CPF ordinary account funds to buy in, potentially earning a higher yield than the default CPF interest rates. The same goes for SRS. Allocating a portion to a defensive, high-yield play like NetLink can help balance your risk and boost your retirement income. But let's not ignore the risks. First, the regulatory environment. NetLink's returns are set by the IMDA under a return on asset-based tariff regime. While this ensures stability, it also means that any reduction in allowed returns at the next review period could hit profits. Second, competition in the non-residential segment is heating up, with telco consolidation leading to some customer churn. Third, and perhaps most importantly, the rising cost of debt. NetLink's ability to maintain its payout hinges on its ability to refinance at reasonable rates. If rates stay elevated, expect more pressure on distributable income. Now let's zoom out and look at the sector. The entire ASEAN telecom space is in the midst of a digital infrastructure boom. AI, cloud computing, and the push for smart nation initiatives are driving demand for faster, more reliable networks. NetLink is investing heavily in upgrading its network and IT systems to stay ahead of the curve. This CapEx is a double-edged sword. It weighs on short-term cash flow, but positions the trust for long-term relevance. In fact, the company's ESG efforts, like reducing fiber waste and improving energy efficiency, are quietly making it more attractive to institutional investors who care about sustainability. How does NetLink stack up against the competition? Singapore Telecommunications, for example, is facing even tougher headwinds, with sluggish revenue growth, shrinking profit margins, and heavy CapEx that isn't translating into higher returns. In contrast, NetLink's monopoly on the passive fiber infrastructure gives it a unique moat. Its EBITDA margin remains above 70%, and it has a negative correlation with US bond yields, which means it could actually benefit if global rates start to fall again. So, what's my verdict? I agree with the neutral rating if your goal is capital appreciation. NetLink isn't going to double in price overnight. But if you're looking for stable, predictable income, especially for CPF or SRS portfolios, it remains one of the most reliable options on the SGX. The current yield is sustainable, the business model is defensive, and the regulatory framework provides a solid floor for returns. Just be mindful of the risks, rising interest costs, regulatory reviews, and the need for continuous CapEx. Before I wrap up, let's talk about actionable insights. For long-term investors, NetLink is best viewed as a core income holding. If you're using CPF or SRS, make sure you're comfortable with the risk-return profile and the potential impact of future interest rate hikes. Keep an eye on the next regulatory review period. Any change in allowed returns could affect the payout. And watch the refinancing of that $510 million loan next year. If NetLink can lock in rates below 3%, the outlook improves. If not, we may see further pressure on distributions. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. To sum up, NetLink NBN Trust is a classic sleep well at night stock for income-focused investors. It offers a rare combination of stability, yield, and regulatory protection, but it's not without its challenges. Rising debt, regulatory risk, and modest growth prospects mean you need to keep your expectations realistic. For CPF and SRS investors, it's a strong candidate for the defensive portion of your portfolio. For those seeking capital gains, you might want to look elsewhere. Thanks for tuning in. If you want more exclusive, members-only analysis, including my top picks for the next wave of digital infrastructure plays, be sure to check out the premium membership. As always, stay curious, stay invested, and I'll see you in the next deep dive.